All right. Thank you, everyone, for joining us this evening. This is part of the investing discussion group with Greenwich Library. And Kristen Jacks is a financial educator and the founder of Money in Your 20s. Kristen studied financial planning at Boston University's Center for Professional Education. She started her career at Kiplinger's Personal Finance magazine and later worked at Mutual Funds magazine. Kristen is a graduate of Duke University. Kristen recently published her second book, Investing, Your Lively, Jargon-Free Guide to Getting Started. So, welcome. Thank you, Kristen.
Thank you. Thank you for having me. And thanks, as always, to Greenwich Library for these fantastic programs that are so informative and helpful. And it's really unusual for a library to care so much about business programming and investing programming. It's really wonderful that you guys do this. So thank you. And welcome, everybody. This is the second season of the Investing Discussion Group. And the theme of the Investing Discussion Group this year is to take the best-selling books that can help you reach your financial goals faster. And we've already had quite a roster of books, and we've had some really wonderful discussions. And these discussions live on YouTube. And if you haven't visited the Greenwich Library channel on YouTube, it's really easy. Just go to YouTube, put Greenwich Library in the search bar. A few things pop up, but what you want to look for is this green logo, this kind of green and white logo, and then that'll take you to the Greenwich Library channel. And they have really great programs across the board, fiction programs, based on fiction books too, and fiction writers. And you can see definitely the last four, or this recent group of investing discussion groups. And that's why we're taping it for tonight. Okay, so today we're going to discuss The Margin of Safety by Seth Klarman. It's his subtitle is Risk-Averse Value Investing Strategies for the Thoughtful Investor. And then looking ahead, just so you mark your calendars, a fantastic book called The Quants. And if you don't know what a quant is, I mean, it's so interesting. When I was younger and in college, like everybody wanted to get like that, that analyst, get into the analyst program on Wall Street or get their MBA and then go work on Wall Street. And it's things have changed enormously because Wall Street might recruit a few people just to do some spreadsheets, like some what they would consider like low level work. But more and more, Wall Street is recruiting people who have PhDs in math, PhDs in physics, all these these super, super, super brainy people who can kind of look for patterns, and then they actually program computers to trade without a human in the middle. They get these very brainy people called quants to look for patterns, and then they program computers to execute trades based on the brain power of these people. And so this book not only brings that to life and really makes you understand it, really makes you enjoy the people behind it and the companies like Goldman Sachs that are doing it, but also tells a really interesting story of stuff going very wrong. So ironically, quants are still being recruited. It's a hugely popular thing, but there's quite a story there. And when it goes wrong big. And so I think anybody who's interested in investing and what like the big asset managers are doing would definitely want to do that on April 9th. So that'll be our next one. Okay, and then just a follow-up for our last discussion was all about startups. And obviously you could start your own business. That's a way of investing in yourself. You could be looking at startups and what other people are doing. So we consider like a startup something that's going to grow. So, you could start a business, you could start like a lawn care business, you could start, you could be a hairdresser, you could be, make the best cakes in town or whatever you want to do. But really, when we talk about small business as an investing opportunity for others, we're talking about startups. So those are companies that are set to grow very quickly, have like a visionary leader and are set to grow very quickly. And those companies look for seed money, and then they eventually look for venture capital, and then they might have an exit by being acquired, or they might have an exit by, having an IPO. So that's what our last one was about. And that lives on YouTube. And it was so interesting how important angel investing turned out to be in that process. And as I was researching it and talking about it, I just got more and more fascinated by the angel investing community and what really goes on and how startups really do get launched. So I'm definitely going to recommend that we have just sort of a standalone webinar just on angel investing. And today I spent several hours with the Connecticut Angel Investor Network, and they're the most sort of legit and traditional group that does angel investing. And this was at Fairfield University, at the business school, and it was really, really fascinating. So I can't wait to share more of that. But if anybody listening now is super interested, the Angel Investor Network, if you are an accredited investor, and so that, and if you are, you probably already know, but it's like you have a certain level of income or you have a certain level of assets saved beyond just, your home, they are looking for members. So if you would like a guest invitation, you can email me and I can hook you up with that network. But it was really terrific. It was really fascinating. And you do not have to put any money down. If you're interested in joining, there's a joining fee. So the fee just gives you access to the deals that they're looking at and sort of the camaraderie and the community of the investing community, but you don't actually have to fund anything. I don't know if they kick you out after a few years if you never write a check, but it was really, really interesting. And actually, the week before, I had spent time with the Tidal River Fund ladies. So that's angel investing, that's specifically women doing investing and trying to kind of find a space that they feel really comfortable exploring the investing. I don't think they limit themselves just to women entrepreneurs, but that was a really interesting group too. They just closed a fund, so they're not necessarily looking for fresh blood right now, but when they start their next fund, they'll definitely be looking for people who would prefer to be part of sort of a women only community. Okay, so before we dive in tonight, because we're going to be talking about investments and in the investing philosophies, I just want to do this disclaimer for myself and for the library. This webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investing philosophies mentioned in this discussion group are specifically discouraged or recommended. If you plan to invest, you are urged to consult a wide range of professionals like tax experts, lawyers, financial advisor, who are aware of your unique needs and situation. Okay, so here we are. Who is Seth Klarman? So the margin of safety, I'm assuming if you signed up for tonight, then you probably know some of the allure of this book. It is a cult classic. People who are really, really into their own investing have tried to get their hands on this book. There are only 5,000 in print, so it's kind of famous for being scarce. It's like the Bitcoin of books. And depending on when you check on your phone, the price, if you go on Amazon, since I took this assignment, it's been as low as $2,000 on Amazon and as high as $3,188. That was yesterday. So it's really cool that the library has a copy. And Siobhan, did you want to talk about if people want to read it on their own?
Sure. So just as Kristen said, because there are so few copies out there, we are fortunate enough to have one, but we do sort of keep a close eye on it. So you can come into the library at any time, come to the reference desk. We keep it there. You can use it in the library. We just hold on to your ID while you are using it in the library. But yeah, you can definitely come and take a look, read a few chapters at a time, or just take a peek at it.
That's great. I'm just trying to hide this video panel. Okay, well, I don't know. Now everybody disappeared. Where this panel is that's giving me my options is covering all of my headlines, which hasn't happened before. Hide. How do I hide it? Oh, there we go. Somehow I hit it. I don't know what I did. Okay, so who is Seth Klarman? He's obviously the author of Margin of Safety. He is a lifelong investing enthusiast. I heard on a very rare interview with him that he started at 10 years old with his first stock. Was a very entrepreneurial kid. He ended up going to Cornell and majoring in economics, and then on to Harvard Business School as a Baker Scholar. And he worked for Mutual Shares, which I've come to understand is just sort of an asset manager that focused on value investing. So he didn't invent value investing, but he's definitely an advocate for it, devoted to it, has organized his whole company around it. Michael Price is another one of these celebrity asset managers, and Seth Klarman was his protege. And then Seth Klarman has run Baupost Group out of Boston since 1982. He's the CEO and portfolio manager. He's had an excellent track record. And most of us regular people could never get into the Baupost fund. It was started by families that have almost like family office level money, which I had asked a friend who actually works in a family office what that even means. So in today's dollars, family offices are you would really need like 100 million to start one. So I don't know what that meant in 1982, but it's these families that were really looking for the best possible management for generational wealth. And then he also takes on institutional clients. But what he has to say, and what he wrote the book for the regular investor. So he was partly writing to other asset managers, but it wasn't just this idea for institutional investors and things that we couldn't touch. Okay, but how can margin of safety help you reach your financial goals faster? Well, I think it's really important for anybody who's serious about investing to understand that there's something called value investing that's actually completely different from the standard advice that is out there. So the standard advice out there is go into index funds, right? And the standard advice out there is you can't beat the market, and don't try to time it, and don't keep money in cash, always stay fully invested. There's sort of all these things you hear over and over and over again. But a classic value investor, I mean, there are things like you can look on Fidelity and there'll be like a small cap value fund or a mid cap value fund. And, so there are things that are called value out there, but they're not as rigorous and thorough and specific as what Seth Klarman advocates. So his value investing is completely different. And it's really focused on getting all the rewards with less risk. But it's very different, and the practices and the mindset are all very different, and the time frame is very different. So we're going to talk about what's normal and how this is different, and then sort of the benefits of it, and then how the practices and the mindset that you'd have to adopt if you wanted to be a value investor, and the specific opportunities that Seth Klarman kind of points to over and over again. So the ultimate payoff is you will make money, and you will do it with much less risk, and you will just feel very satisfied that you've made prudent choices, that you're buying things at a discount. There's much less risk because whatever you're buying, the several things you might end up buying are all going to be their intrinsic value is much better than their current price. Yeah, so you'll make money because sooner or later the market will recognize that the value is greater, and you can sleep at night because your portfolio is not going to go like wildly down like it could with just a typical stock portfolio. Okay, so we have to go back to the background of what happened with investing that made it so normal that you have to be there's the efficient market hypothesis, you can't beat the market, you should be in index funds. I mean, all these philosophies literally did not exist prior to the 1970s. So prior to the 1970s, the efficient market hypothesis never existed. So you have Eugene Fama at the University of Chicago. You have all these really smart, convincing, persuasive, energetic academics that are coming out with all these theories, and they're attacking at that time an industry that was very vulnerable to attack. So you have an investment industry that is charging outrageous fees. So I don't even think we can comprehend. I mean, now if you're at a discount broker, you don't even get charged a commission. I mean, these are commission-free trades. Back then, commissions were 8% of the total value of what you were buying. We also have tax advantaged accounts. I mean, we have 401ks. Those did not exist back then. So there were all of these problems of being charged too much for the investments you were going into. And then when your investments were moved around, when you got sick of one investment, or a broker called you to convince you of something else, well, then you have like a tax consequence because you sell out of one thing and buy another. So then you're incurring another charge. So there were all of these really good academics who wanted to kind of save the regular person from high fees and tax consequences. And they went about it by, in their research, they claim that there's really no reason to actively select stock. I mean, at that point, it was mostly talking about stocks and bonds. So there's just no reason, and mostly stocks. So there's like no reason to evaluate stocks, pile into them, think one is better than the other, because they claimed you're not gonna beat the market. The market is already efficient. The price you're seeing reflects all of the information. You're not going to be smarter than the next guy. So Paul Samuelson, one of the key academics at the time, was making this plea to Wall Street: would somebody please start a fund that just kind of mimics the S&P 500, just mimics the performance of the top 500 American companies. So he made this plea, and Paul Samuelson was a famous, like a Nobel Prize winning economist. And John Bogle of Vanguard was, I think, at Princeton at the time, or he might have been actually out at Wellington Management, but he took up the challenge and was like, yes, I'm going to create an index fund that just mimics the S&P 500. There's not going to be, big commissions. There's not going to be a lot of, trading in and out, because we're not evaluating companies. We're not picking. It's just, if a company is in the S&P 500, then that's what we're investing in. And so a lot of people don't know that that's not the way things used to be. I mean, this is the reality we've all been like swimming in. But prior to the 1970s, there were no index funds. There were no 401ks. So really, how we do things today, you get a new job, you get your 401k menu, and you're probably going to go into an S&P 500 fund. None of that existed. So what did exist seemed to be not serving the regular investor, seemed to be ripping off the regular investor. All of these academics were really, really motivated to help the little guy. And they did, and index funds were created, and that's great. But a lot of people would argue they went too far. So actual practitioners, actual asset managers, thought the efficient market hypothesis was wrong. It was like, you don't have to spend too much time in the stock market to say this is not efficient. I mean, maybe price is technically true. The price of a stock or whatever reflects all the information that's out there. Okay, that could be a true statement. That doesn't make the market efficient. In fact, a lot of famous investors said, not only is the market not efficient, it's literally manic depressive. It's literally bipolar. So Benjamin Graham, the father of value investing, he used to recommend that investors imagine that they have a business partner named Mr. Market, and he's manic depressive, so same thing as bipolar. And he wants to either buy your interest in a business or sell, he wants to buy your interest or sell you his every day at wildly different prices. So that this is like, as someone who invests a lot, like this is much more of a reflection of what typically feels like what seems to be happening in the market with all the wild price swings. I remember in my latest book, when I was talking about, I have a chapter that just says, why did that stock price move? And it talks about, in 2021, a lot of stocks went through the roof, like household names like Facebook were like through the roof. And then 2022, they just completely got destroyed. So to put some numbers behind it, I think like Facebook was at 400, then it was at $90, and now it's at $500. I mean, that is such a roller coaster ride in an environment and a backdrop where what's going on in the macro level, doesn't really explain why a stock would be that take that much of a roller coaster ride. So the academics are trying to say you can't beat the market, it's efficient, the prices make sense. And the practitioners were saying, well, that's not true. You just spend some time with the market. That's not true. And the value investors definitely said that that's not true. And now today you have all these Nobel Prize winner. So now the academics are at war with each other. So it used to be the academics were at war with the asset managers. Now the academics are at war with each other because there are professors, PhDs at all the top schools like Yale and U Chicago saying, no, it's definitely not efficient. There's this human factor. And so now you have behavioral finance coming forward and saying there's so much emotion in securities prices. There's so much that's irrational. There's so many biases, whether it's like the home country bias, like people who want to just buy companies that are in their home country, which isn't so bad if you're in the United States, but like if you're in Australia or you're in Ireland, it's like you really should be branching out. Or you have a recency bias, like whatever happened more recently feels more true and more probable than what happened, 5 years ago. Well, that doesn't make any sense because anything can happen. So anyway, this is the backdrop of value investing. So value investing is saying, forget that efficient market camp. It's completely wrong. And you can absolutely find opportunities. And by the way, our last session for our sort of investing year is almost like the school year. Like we started in September and we're going to end in June. And for our final book, we're going to talk all about behavioral economics and behavioral finance and all of, what's really going on now, which is, presents a lot of opportunities when there is panic. There's definitely opportunities to buy when there's palpable fear. And there's also a cautionary tale of like, as you see irrational exuberance, as you see stock prices go up and up and up, or like now Bitcoin's making all new highs and things like that, caution, because we've been here before, like markets overreact in both directions. So, if you made some money on Bitcoin, great. You might want to take some profits because we've seen this movie before. Anyway, so that's our final book. But so Seth Klarman comes along and he's challenging the academics and he's challenging the indexers and he's challenging the people who say, you can't time the market and you don't have anything in cash, just put everything in index funds. And he's joining people like Peter Lynch and Bill Gross, who became very famous fund managers, saying there's opportunity there. So the bottom line is there should be actively managed funds. You should be looking for very smart asset managers to guide you and help you find opportunities. Otherwise, by definition, with an index, you're just going to end up with the average. I mean, that's what indexing is. Okay, so loved Seth Klarman's book, loved Margin of Safety, but I have to say, having read it cover to cover, that if you in particular just love stocks, then you should stick with One Up on Wall Street, because so much of what Seth Klarman is saying, Peter Lynch just said brilliantly in his book, One Up on Wall Street. And Peter Lynch is also hilarious. So that that's something to keep in mind. And yeah, just, the whole, like, the market isn't efficient. There are opportunities out there. Buy at a discount, never buy at a high price. I mean, a lot of those things, he's just perfectly overlapping with Seth Klarman. Now, I'm trying to think. Seth Klarman wrote his book in 1991. Peter Lynch was manager from 1977 to 1990. So One Up on Wall Street probably came first. I'm not saying he ripped anything off, but anyway, they were kind of operating at the same time. And then Peter Lynch is retired and Seth Klarman has moved on. Okay, so what is value investing? Let's just be clear. Value investing, so Margin of Safety, is a book all about value investing. Value investing means purchasing investments at an appreciable discount from underlying value. Okay, so that's what value investing is. It's completely different from indexing. It's really scrutinizing a security, looking at its price, not thinking that the price reflects all information and everyone's smart and there's been good price discovery. So it's the idea that you should spend time looking for discounts out there. Okay, so what are the practices? What's the mindset? Let me delve into that a little bit. All right, so we talked about, the academics, and A Random Walk Down Wall Street was one of those books that we covered earlier in the year by Burton Malkiel, who's at Princeton. So Burton Malkiel he really makes the case, you can't beat the market, and kind kind of saying like everything that Wall Street is doing is just so silly, having all of these analysts reviewing all these stocks, that's just useless. So what's interesting is Seth Klarman's saying the opposite, but there is an overlap. And the overlap where the academics and Seth Klarman agree, they agree that technical analysis is a complete waste of time, which if you don't know what technical analysis is, if you've ever seen these guys that, and they have like YouTube channels and all these things where they're always looking at charts and they're always looking at price movement and volume. So like, how many people piled into a security? Did the price go from a low to high or a high to low? These circles down here are support levels, supposedly, that the price kept bouncing off of a certain low. So that's a support level. And you can be kind of confident that the price isn't going to go below that. So there are technicians out there. There are people who are just obsessed with just charting price and volume over time. And Seth Klarman and all the academics, this is the only area, they agree in two ways. They agree that technical analysis is a waste of time. And they agree that in general, Wall Street is trying to rip you off. So that's a whole other seminar. We could take a lot of time on it, but you always have to think, if you are using a broker, if you are using a financial advisor, how did they get paid? And what's their motivation? Like, do they really have your best interest at heart? And there are a lot of good financial advisors out there, but just in general, financial advisors typically are either paid a commission or assets under management. So right off the bat, if the best thing for you to do in your personal life, if somebody really looked at your financial situation and you have a second mortgage, you took out a home equity line of credit, you should probably pay that off. Those are like floating rate loans at this point, and interest rates have been going up. And nobody knows if you can make like 8, 9, 10% on your investments. But if you know for certain you're paying that on a loan, then the best use of your money is to pay down your debt. Car loans have become pretty expensive, so better to pay in cash than to take out a loan. So these are things that Wall Street will never tell you because they get paid by moving your money around in securities, and they get paid by assets under management. So they're not going to have you take your assets elsewhere, even if that's the smartest thing for you to do. Maybe you don't have enough insurance, right? Well, they don't want you to go buying insurance because that takes money away from them. So a lot of people just agree that you have to be very, very skeptical about what Wall Street is telling you to do. So that's sort of the healthy skepticism that everyone is talking about. And technical analysis is a waste of time. So there's their agreement. So there's also a skepticism, realizing that investors are emotional. So when there's panic, you got to remain calm. And when there's exuberance, like there is right now with Bitcoin, you have to be cautious. So successful investors demonstrate caution in frothy markets and steadfast conviction in panicky ones. That's a big theme of the book. Seth Klarman in the book says that really, like, if you're a value investor, you're automatically a contrarian because even though everyone learns you're supposed to buy low, sell high, he says that what's more typical is that people get caught up in, there's, FOMO, fear of missing out. People chase returns all the time. It's so sad to watch because it's like the worst thing you can do. You finally start paying attention to investments when you've heard that they've gone up, up, and up, and then you kind of want to get in because you think it's a sure thing. I mean, that's usually like the worst time to get in. So it's a contrarian view because you're not riding that like typical emotional wave of being excited about a market that's going up, fearful of a market that's going down, because you want to do the opposite. Okay, another thing about value investing, which you would not think that this is the opposite of what's normal today. So value investing is really, really, really into skepticism and deep research. And what I mean like that is sort of like, think of it like dating. You go on a date and like the externals look great, right? Well, that's going to be true with companies too. I mean, like Disney and GM and Starbucks, they all have like fantastic marketing, and you probably even like their products, but you have no idea how much debt those companies are in, what their sales have been recently, if there's any litigation that the companies are facing. I mean, Starbucks is going through a lot of pain with, different Starbucks wanting to unionize. So what a value investor will do is say, like, you can be sort of intrigued, attracted to an investment, just like you would be on a date, but you're going to get deep, deep into the research, and you're going to be very, very skeptical. So, for example, like on a, what if, like on a date, like what could you, if you actually had access to the information, you meet this like attractive person, but what if like privately you could find out like their college transcript, their credit score, what was their employment history, how much debt do they have? Not to be unromantic, but that could tell you a lot about whether or not you'd want to invest in that person. It's the same thing in value investing. You're going to do a deep dive into financial statements. You're going to look at the balance sheet. You're going to look at the statement of cash flows. You're going to look at that over several years, right? You're going to look up the company on the news. I mean, so I think these companies have to discuss risk factors in their annual report. So if they are facing threats of being unionized, that should be in the annual report. But in any case, you're going to do that deep dive. Now, this sounds obvious, right? Like, obvious. Like, you would not spend thousands of dollars on an investment and fail to just do a few Google searches. I mean, these days everything is online, so you wouldn't think this is so unusual, but it is literally the opposite of what index investing is all about. So in index investing, you just follow the index. So whatever the top 500 companies are, that's what you're going to get. I mean, I keep using the S&P 500. Obviously, there's an index for everything now. Like if you wanted to do, because there's also a benchmark for everything. So if you wanted to do like a small cap fund, right? The small cap index does not care about like which company it is, what product they make. It just meets the criteria of being among the other small caps, and indexes are just cap weighted. So if a company has a market capitalization of 400 million, and that meets the criteria for this index of small cap funds, and it goes all the way up to companies that have, the last time I looked at some small cap funds, the companies were pretty highly valued. I was surprised, like some up to like $8 billion, which you would think would be a mid cap, but the market's kind of overheated. But in any case, there's no research. There's just like, if you are a small cap and you have a certain market capitalization, you're in. And it just doesn't matter what your last earnings report was or how much debt you have, or it's literally just taking the average and just collecting all the companies. And now, as someone would argue that the cap, because indexes for the most part are cap weighted, that there is some selection going on, because the stock, the company would have a higher market cap because people consider the stock more valuable, and therefore it has a higher market cap, so therefore it'll be a bigger part of the index. So some people would say like there's like a de facto voting going on, or research going on, but technically there is no research. Like there is no fund manager there. If you're in an index fund of any theme, whether it's small stocks, large stocks, growth stocks, value stocks, nobody is doing individual stock research. Nobody. If you're in the index, that's it. So obviously value investing is very different, because you're not just automatically in, you're not part of any average. Okay. Back to Peter Lynch, who I really love, Seth Klarman's channeling Peter Lynch, or Peter Lynch with channeling Seth Klarman. But they say people are very careful when they buy a dishwasher. They'll do some research, but they'll put $10,000 on some stock they heard of on a bus. So this is like this frustration of like not doing the deep dive, not doing the due diligence. Okay, Now, in my recent book, chapter 3, why did that stock price move? So I've been talking about like the stock prices like bouncing around, and Seth Klarman talks about opportunities and, and to really do a deep dive into stocks. And so if you're going to see like a stock has gone down and you might have an opinion about it, it's really good to look. So in this one chapter, why did that stock price move? I really looked at all the things that can happen to a stock price, not just good news, not just the fundamentals, right? Those are the things like the sales revenue and the profit and the debt level and things like that. But there could be, the macro environment changed. It could be management is actually buying stock in its own company, which is always a bullish sign. It could be management is selling, which is a bad sign. It could be tax loss harvesting. There are all these things that can move a stock. So if you are interested in value investing, you're going to want to educate yourself on those sort of themes and those ideas. And this isn't just me speaking. This is Seth Klarman speaking. He talks about in margin and of safety. He talks about the opportunities of certain stock price moves. So if you would like that chapter for free, I am happy to send it to you. It would just be a PDF. Just email me, kjacks@moneyinyour20s.com, and I'll just email you that particular chapter so that you can start doing your own research along with Seth Klarman. Okay, I'm going to try to get somehow. I cannot see if there's anything in the chat. Oh, there, now I can. Okay, so I just want to say if you want me to stop at any point and answer a question, just put it in the chat. Now, I saw the chat and now the chat went away. Oh, here we go. Okay, I got it now. All right. So if anybody has a question, you can just put it in the chat. And then at the end, we also open it up for discussion and for questions. Okay, so okay, all right. So now we've got the skepticism. Oh, okay, relationship to time. This is a really, really big thing. So everything Seth Klarman is saying is counter to what is standard right now. So another thing that's standard right now is people kind of obsessing on year to year performance, right? So, and people selecting asset managers based on like, oh, that person had a really good year. Their fund was up 14% or whatever. And this other fund was only up 7%. And Seth Klarman says that is really, really a bad habit, because some of the best investments that you want to make, like, you have to be able to tolerate that they might not look good. If you're trying to get in at a discount or you're trying to find some like diamond in the rough, it will probably not behave in kind of a timely manner, right? So you have to let go of, I want to look at, my end of year statement and see that I guess the most normal thing is people will probably compare it to the S&P 500, right? Like they'll say like, oh, the market ended in 2024, the market ended up 10%, but I was only up 7%. And then they think that they've somehow failed. And he's like, you cannot take advantage of the rewards of value investing, and the biggest reward being much less risk, because he's saying value investing, he personally, and value investing in particular, you're much less likely to have bad years. So if you're following his advice and you're buying things at a discount, they don't crash the way like, Bitcoin today at 71,000 is likely to crash, has crashed several times. Bitcoin, this would be, if it crashes, it'll be the fourth time it's gone down 80% in, however many years. So in any case, you're taking less risk, but also if you're so wedded to year looking at performance and comparing it to the market, comparing it to the S&P 500, you're going to be disappointed, because you just have to kind of let your hands off the wheel in your relationship with time. So you have to think of, he calls it kind of like absolute time rather than relative time. So you might get into, I'm going to say stock, but he does a lot of things other than stocks. But let's say you get into a stock and it takes well more than a year for the market in general to recognize the value of the company. So you could be sitting on something for a year and a half that's barely moved, and you're watching NVIDIA double, and you're thinking, oh, this is ridiculous. Like, why didn't I just go into the growth stocks or the Magnificent Seven like everybody else? And he's like, yeah, that's the absolute wrong mindset, because also those things, very often they don't end well. But you will eventually get rewarded. It's a much slower process, with much less risk, but the rewards are not fast, and they're usually not evident. So you've got your skepticism, uh, especially about Wall Street. You've got your deep dive into the research. You're going to do your fundamental analysis. You're not going to be wedded to time, like every 12 months sort of thing. And then counterintuitively, he actually talks a lot about, you would think that like value investing is like very conservative, but it's not conservative in the way like when everyone's panicking, you just kind of hide under your couch. He's like, no, 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 those are the opportunities. So when you see panic, then you kind of jump in. And when you see investments that are kind of complex, like maybe like right now, like 3M is a stock that's just been pummeled over its pending litigation. And if you have the ability to really dive into that and to monitor what's going on, if you have some sense of how litigation usually goes or what's the worst case scenario, like that could be an opportunity, but that's sort of a complex idea. So if you take the time to read Margin of Safety, these are not quick hit ideas. This is a discipline, this is a viewpoint. It takes a lot of work, and it also takes remaining calm when other people are panicking and avoiding the euphoria when other people are piling in. And then there's sort of this perception versus reality thing where, and you'll see this on, like, if you go on your 401k statement and you look at not your statement, your menu, right? Like, so if you have access to a 401k and you're looking at like what your options are, there'll be value funds and there'll be growth funds. So you might get the idea that they're completely different, right? That some stocks are value stocks and some stocks are growth stocks. And some opportunities are value oriented and some are growth oriented. And growth is pretty obvious and it's really easy to understand. Obviously, everything AI right now is growth. If you were really into Etsy around the pandemic, when it was sort of like all those people at home, kind of creating their own like beautiful whatever, knit tops and stuff like that. So Etsy kind of took off, and the growth of Etsy was like really, really spectacular. And so that was a growth stock. Anything that's kind of growing quickly or gaining market share or things like that, those are growth stocks. But it doesn't mean that a value investor never buys a growth stock. And so this is another point from the book, and it's kind of it's confusing to people that what a value investor is doing is looking at the growth stocks and then trying to decide which ones are selling at a discount, where whatever assumptions are being made about their growth, maybe the growth is going to be even better, or the price is so like very often with growth stocks, like they get bid up, like everyone's interested in growth stocks. Everyone can have kind of a rosy view of the growth continuing. So the price gets bid up and up and up. Like Nvidia is through the roof now. It's like $900 right now. And so its price to earnings ratio, last time I checked, was like 77. I mean, it's like the multiple is unbelievable. But there can be situations where a value investor will look at a growth stock and say it's a value stock because of their own calculation. It's trading at a discount of its underlying value. So Seth Klarman did this recently with Coinbase. And it got a lot of, so Seth Klarman's very, very reclusive, elusive guy. He hardly ever gives interviews, but he did come on Capital Allocator, and which is run by Ted Seides, who is a Greenwich person. It's a fantastic podcast. And he did kind of disclose that he had a position in Coinbase through convertible bonds. And if you have any of this myth about value versus growth, you would be like astonished. That seems like the craziest thing for a value person to do. But if, Seth Klarman is a really smart guy. He has an incredible team, and they were able to sort of see that Coinbase had a lock on the future of cryptocurrency. Like if someone's going to open a cryptocurrency account, they're going to do it at Coinbase. I mean, maybe they did it at Robinhood, but Robinhood was kind of exiting the market. So he could see that Coinbase was like, for good or ill, cryptocurrencies are popular, and Coinbase was going to be the place that people were going. And it was just going to grow, grow, grow. And so even at its wildly high price, it was still sitting on a lot of cash and a real value. So that's the whole point. It can be a growth stock, it can be a growth security, it can be a growth private company, as long as the price that he can get it at is much lower than the underlying value. And that's where the margin of safety comes from. It's much lower than its underlying value is that margin of safety. So if he can buy something that he thinks he can buy it for a price that's like 30% below where it really ought to be, that's this huge margin of safety. So a lot of things can go wrong in the business, a lot of things can go wrong in the economy, and he's still good, right? I guess it would be like, having the opportunity to buy a house in Greenwich for only $1 million, in the right location, so it's only $1 million. It doesn't mean it's cheap, but it's, the same house should have been $2 million. So he talks about getting things that are at a discount that of literally like 50% off, but that's when he gets really into the complexity of things that he understands that maybe the average person doesn't. Okay. Opportunities. So this is the part of book where he really gets into the specifics of opportunities. And I'm just going to take 1 second to look and see if there's anything in the chat. Okay. So yeah. So like we said, if you have any questions, just put them in the chat. But it's not surprising to me that he talks about small cap stocks. Because again, he's looking, he's saying, okay, the market is not efficient, but there is a process, right, to price discovery in this market. And a lot of that process is analysts reviewing companies and then putting a price target on the company, or putting a buy or hold or sell review rating on a company. But the universe of analysts, the universe of asset managers and their analysts, they don't cover everything, right? I mean, there's the Russell 2000 is the 2000 small, so there's the Russell 3000, but then there's the Russell 2000. So you have like the 1,000 stocks above the Russell 2000. And you get down into those stocks and it's what's called like not covered, right? So analysts are not covering those stocks. So where Klarman sees opportunity, things that are not well known, things that are not obvious. And it makes a lot of sense. And this is something that Peter Lynch talked a lot about. And it's also something that I personally have really, really enjoyed. And so I'm trying to think of things that I have done that would be very recognizable. So there's this company like The Honest Company, which is, so is it Jessica Alba? I'm getting my celebrities confused, but so The Honest Company, it's a little bit like a Gwyneth Paltrow, like super back to nature, very environment friendly, top of the line products. So The Honest Company, I think, and they even do like children's clothing and diapers and products like that. And it had this great debut. So in 2021, everything, the market was wild hot, and so many things came to market. There were so many IPOs, so many small stocks got bid up. There were SPACs, which I'm not going to get into, but it's kind of a unique version of an IPO. All these things came to market and they were just bid up like crazy. And then they crashed in 2022. Really crashed. I mean, a lot of the stocks that I follow them just because they got down to like $1. And I'm thinking, so this again is like what Seth Klarman talks about, where the market can be, it's bipolar. So it's too high when it's high and it's too low when it's low. And, in the 2021, everything got bid up and went super high. But then there was this shakeout as though all of these companies weren't going to be viable. And a lot of them got down to $1. And I'm watching this and I'm thinking, there are companies like The Honest Company, like Select Quote. So I don't know if you've ever listened to these radio ads, right? Where they're like, you're going to need term life insurance. I mean, this is a boring thing, but yeah, so you need term life insurance. So, well, call Select Quote because they're going to shop around and get you the best term life insurance that you can afford for $18 a month for blah, blah, blah. And I watched The Honest Company, I watched Select Quote, I watched a bunch of them. And I thought, well, okay, yeah, they never should have been that high, but now they're priced as though they're all going out of business. And that doesn't make any sense. That's just this inefficiency. That's just this bipolar behavior of the market. And sure enough, a lot of these stocks have doubled, and it doesn't take much for them to double if you're already $1. So I think that's why Seth Klarman talks about these small cap opportunities. I'm just going to actually, I on my Yahoo Finance, there are a bunch of companies I follow that all sort of had this like crash. And some of them I think, probably should have crashed. I mean, there was this Rivian and Lucid, and also the whole electric car thing got completely out of control. I don't, this bipolar nature of the market. This is this irrationality. So you have like Rivian. I mean, I'm looking at. It looks like it used to be $100 and now it's 12. Lucid, another electric car, looks like it went up to $55 and now it's $2.92. So I'm not saying that everything that was high is now a buy. Like I wouldn't buy those because I think the whole electric car market is very iffy. I mean, the whole messaging around whether or not these are environmentally safe, who's going to end up being the best, whether or not these cars can work. Though they run out of electricity or people can't get to, their stations. Very, very, very questionable. But just scrolling through here, not Petco. I wouldn't. Oh, actually, let me talk about Petco so Petco, well, everybody knows what Petco is, just like PetSmart, but their ticker symbol is WOOF, woof, very cute. So that's a stock that's down to like $2.56. So if you have a very basic view of value, you might go, oh, well, everyone's heard of Petco and the stock's trading for $2.56. But no, 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 no. Seth Klarman would not go near Petco. And I'm not expecting you to go into their financial statements. But one trick that I like, and I really get a lot of use out of the library. So the library has S&P Advantage. You can only use it if you go into the library, but you can look up bond ratings of publicly traded stocks. So any company that's issuing bonds, for the most part, I mean, there's always an exception, but these large companies, they're issuing bonds, they're going to have bond ratings, right? So let the bond rating agency do all of the deep dive research for you. And then you can look at the rating that the company got. Petco has a really, really bad rating. I mean, it's an under investment grade rating. So Petco bonds are considered junk bonds. Well, that means it's really, really risky, like super risky. This is not a stock that is just trading at a low price and worth, it's not a value stock because it's too risky, is what I'm trying to say. So not cheap is not the same thing. Trying to see, just scrolling through. So I had The Honest Company was probably my best one. Select Quote was another good one. And then, you just never know, like Allbirds. Allbirds is trading under $1. It's a shoe company that is kind of popular with, I don't know, started in California. It's a very comfortable shoe. Now they just announced some like not great earnings and the CEO is switching and blah, blah, blah. But again, if this company doesn't go out of business and it's trading at like 90 cents, interesting. So these are the things that Seth Klarman was talking about, these possible opportunities, partly because not enough people are following it, right? So you might see that something's trading at a very low cost and nobody's following it, but you think at the very least, if it doesn't go out of business, then you're going to do okay. But if they have any good news, it could be spectacular. So there's a company, Babcock and Wilcox, that was my first 10x stock. And it was basically, again, a value investing idea of people overreacting. That ticker symbol was BW. And people were overreacting. And I think, got in around $1 and then sold out at $10 and things like that. Okay, so small cap stocks, definitely. He also talks about, when he talks about investor constraints, what he means, he's talking about institutional investors or endowments or groups that sit on a ton of money. They sit on a ton of investments and they might have some investing rules. So Seth Klarman looks for these things. Like, for example, the rule might be we only invest in stocks that have a dividend. So then if a company comes out and says they're suspending their dividend, which is not a good sign, right? Like that usually is a sign of things are not great with the company, but it can create a wild overreaction, like wild selling, because some big endowments or groups or whatever, they have investing rules and now they're not allowed to own that stock because the dividend has been suspended. Well, they're rushing for the exits. They have to sell. So they're going to have to sell at, there's going to create like a depressed price potentially because there's going to be all of this selling all at once just because investors are constrained. They're constrained by their rules. Okay. If a company's bond rating falls below investment grade, that's another typical constraint that could create like a buying opportunity because, again, these investors have to sell to fit their rules. There might not be enough buyers at the time they want to sell. Now the price is depressed. It creates an opportunity. Tax loss harvesting is another opportunity. I hope I'm not losing you with all of this, but if you signed up for tonight, you are hardcore investors. So this is good. But like tax loss harvesting is another thing where if a stock has been down, a significant amount leading into the end of the year, well, investors can offset their gains in other stocks by selling a stock that's had a loss. So like gains and losses can eliminate each other, wipe each other out. So some people, as it gets to the end of the year and they look at like what their tax consequence is going to be of the investing they've done, if they kind of have too many gains and they don't want the tax consequence, they'll search their whole portfolio for the stuff that declined throughout the year, and then they'll make it decline even further because of tax loss harvesting. So these are just, this is a typical thing that a value investor is going to do. I'm going to look at the next slide and make sure I'm not forgetting something. Oh, there it is. There's your tax loss harvesting. Okay. So yeah, this is a textbook example of a stock that was going down, 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 and gets to be December. But then it recovers because it just got way too beaten up because of tax loss harvesting. And then it recovers and then it kind of levels off. So there's usually like an opportunity there with tax loss harvesting. Okay. So complexity. Just suffice it to say that if you're really, really into value investing, then you might drill down into companies where the problems they are facing are complex, but the problems are complex, but maybe not that threatening. And so the stock is going to have a problem, or the company, it doesn't even have to be a stock. I mean, there can be issues with bonds that are complex. Like for example, one issue with bonds in 2022, when bonds were just getting hammered, a lot of bonds were owned in bond funds, right? So bonds are not necessarily that liquid. Like treasuries are very liquid. Large corporation bonds are pretty liquid. But you have sort of like mid-market bonds or junk bonds. A lot of things are not that liquid. And then bonds were having a terrible year and people started to panic. So they go to their fund and they want their money back. So now the fund manager has to sell the bonds that he's sitting on, even though they're fine, they're perfectly good, and there's no buyers. So this is kind of like, you would think this isn't complex, that this is just like kind of a normal situation because it's a panic. But it is kind of complex because a lot of people don't really go looking at bonds. Like they might know there's a panic in the stock market, but they don't really think of a panic in say junk bonds. So this is like a complexity plus investor behavior sort of thing. So these are just a way of talking about opportunities. And I personally have never done anything with distressed debt, and I'm constantly confused about like what's so a junk bond is just something that like you know you can have something that originates with a junk bond rating, right? Like that it was never an investment grade bond. It doesn't mean it went into distress. It just was just always that way. So ever since Mike Milken, you can have like kind of new issue junk bonds. Distressed debt is different, and those are like more like the fallen angels and things like that, the companies that get into distress. And I think it usually means like a bankruptcy situation, but I could be wrong. Anyway, Seth Klarman, he's doing that. I mean, Seth Klarman can do whatever he wants because he's got $25 billion to play with, and he gets into a lot of private deals that we can't touch. But anyway, these are, the theme for him with these opportunities are, looking at always being skeptical, always doing your research, stay calm when other people are panicking, sell when things get too frothy and exuberant. So I'm hoping that this is making sense. But the one thing I do want to point out, since you will see everywhere, if you go on your brokerage, if you go to your brokerage account and you just click on mutual funds, you're going to see the word value everywhere. There's going to be large cap value, small cap value, mid cap value, everywhere. So it's the logical, there's a logical question of, well, after hearing all of this and realizing I personally would never do all the research, can I just buy one of these funds? Wouldn't I get Seth Klarman like returns if I just buy one of these funds? And the answer is absolutely no. So sadly, you cannot mimic Seth Klarman for a variety of reasons. Number one, mutual funds have to give money back when it's requested. So you are at the mercy of other people panicking. So it's a mutual fund. You have mutually all pooled your money. And one of the big tenets of value investing is that like you're going to manage your emotions, you're not going to panic, you're going to buy in the panic, and you're going to sell when things get like too frothy. That's pretty much the opposite of what other people in the mutual fund will do. So if you're in this mutual fund, and this is exactly what happened with bonds in 2022, bonds were not doing well. And bonds, people had a very, like a misperception that bonds were safe. So losing any money in bonds was jarring for a lot of people. Well, some bond funds lost like 20% and or worse. I don't even want to talk about the super long duration ones. So there was a panic. And a lot of the losses then are the bond, the fund manager cannot get a good price for those bonds because there are no buyers. They have to sell in a panic because the people in the fund want their money back. So the very first reason you can't just use mutual funds, that even if they have value in the title, is that there's no lockup, right? So people put their money in and they can get it out at any time. And that means you can't control for the behavior. And that's really, really, really bad. So interestingly, what a lot of hedge funds do, they control the flow of the money because there is a lockup. So even if you're, the head of the Yale endowment or anything, you've agreed that you won't request to have your money returned to you immediately, that's part of being in the fund. And that's something that Seth Klarman gets to do because he's Seth Klarman. Other problems with a lot of mutual funds will call themselves value, but they don't really follow the basic tenets. And the way I see it now is that like for example, this specific fund, when I looked at how those stocks were trading, the thing that you notice is that a lot of them are very, very high. Like they're looking back in the last 5 years, they are super, super high for their 5-year track record. And you don't see any selling. So that's problematic. Like part of the discipline of being a value investor is you sell your winners. You have to keep asking yourself, is the story still true? You know, did I, like, I bought at a discount, but now has this reached normal value, right? And for whatever reason, asset managers, you know, the typical mutual fund guys, they're might make some good calls and get into things that are good values, but then they don't like to sell. And then, you know, pretty much you've missed your opportunity because the sooner or later the market's going to reverse. So that's just two of the things. And also Seth Klarman's a genius. So and it's hard to, you know, get the genius, but maybe you are a genius too if you follow his advice. Okay. I'm going to jump to this one. So Seth Klarman, super reclusive, elusive guy. He almost never, ever gives interviews. But he was asked to take on some project. So there's a book, Securities Analysis, and he was asked to do the latest edition, and he pulled in all these other really top people. And so I think he had some, you know, he was very excited about it, kind of wanted to put that out there. And other people snatched him up and got some interviews. So Capital Allocators, fantastic podcast with Ted Seides. Ted Seides is a Greenwich guy. He gets the best speakers. So somehow he got an hour plus interview with Seth Klarman recently. So this was last July. And it became the #1 capital allocators podcast of that entire year. So if you've been at all intrigued by tonight, I always think it's really interesting to just listen to the author himself, because he's going to, you know, especially because he wrote this in 1991. So he's also going to tell you like where his head is at now, maybe what he would have done differently. A lot of it has held up. You know, absolutely a lot of it is held up. He's saying things like book value, which nobody was really investigating anyway. He's like, he wouldn't really do that much with book value. Intangible assets, he would give more credence to intangible assets. That's very, very like getting into the weeds type stuff. But I would definitely listen to that. And he was also on, so CNBC has Squawk Box, and then they have the podcast Squawk Pod. And that was, so I guess there was the summer of 2023, he came out of hiding and actually gave these 2 interviews. These were the only 2 that I could find, and they're both worth a listen. And then I just want to remind you, just in case if people are signing off, the next webinar is the Quants, and that's April 9th. And hopefully you will sign up and be there. Okay, so questions, any questions in the chat? I've been doing all the talking. I hope this was helpful. I will toggle it back to, why don't we go, oops, wrong way. Let's go back to, all right, so this is kind of how the margin of safety can help you, talking about how value investing is completely different, what the practices and the mindset are, what the opportunities are. Was there any part of this that didn't make any sense? If you have any questions at all, if you're wondering how you personally can read the book, you have to come into the library. If you want to ask Siobhan now to put your name at the top of the list, that would be good. But you do have to come into the library. And yeah, so any questions? Anybody out there want to, in the chat, say, can I have the copy this week of the book? Let me know. All right, so I'm just going to say my email is kjacks@moneyinyour20s.com. And there is one thing in the chat, actually. So if you want that free chapter, just email me and let me know. Oh, going to the library next week. Fantastic. You might in the chat want to like find out, get Siobhan's email or something and alert her, because You don't, you want to make sure it's there for you and somebody else isn't reading it, then there you go.
Yeah, I mean, it probably isn't an issue. So if you just stop in and ask at the reference desk, we should be able to grab it for you once Kristen brings it back to us.
I will bring it back tomorrow, I promise. All right.
All
Well, I
right.
think that's it.
Okay. Thank you so much, Kristen. Thank you for everyone joining us tonight. And hopefully we'll see you next month.
Sounds great. Thank
Thank you.
you. Good night.